All right, we're looking at the Jay Simpson case study on portfolio management. Let's scroll down and read question 1. Which of the following would be most appropriate benchmark for UP's portfolio? The Lehman Brothers Corporate Intermediate Bond Index, the Merrill Lynch Long-Term Corporate Bond Index, or the Merrill Lynch Long-Term High Yield Bond Index. So it looks like a couple different factors at play here. We've got intermediate bonds and corporate bonds, long-term corporate bonds, or long-term high yield. So it looks like we're going to have two decision points here. Corporate is kind of implying corporate versus high yield. That's kind of implying investment grade versus corporate or versus high yield. So we're looking at high yield versus investment grade, and then intermediate term versus long term. So our benchmark, we're going to want it to match what our portfolio goal is basically. Jay Simpson works for the Fine Fixed Income Management, a debt management firm operating in Michigan. FFIM is responsible for managing fixed income portfolios of a diverse clientele comprising both private and institutional clients. Simpson manages a portfolio worth $10 million funded by U+ Enterprises, UP, a firm that offers construction equipment. The fund is being managed to generate a stable income stream for the next 10 to 15 years. In addition, conservation of principal and reliability of income are primary objectives outlined in the IPS. Simpson is selecting bond issues to include in the portfolio, after which he would select an appropriate benchmark index. All right, so we've got a lot of information here. So we were looking for stable income, conservation of principal for the next 10 to 15 years. So like we said, our benchmark should kind of closely match that. So we're looking for stable income, so that and reliability, conservation of principal. So we're probably going to rule out high yield bonds for that reason. And then next decision point here is intermediate versus long term. 10 to 15 years is going to be considered long term. So we'll go with B. Intermediate term is probably going to be more in the 5 to 10 year range. That'd be something like the AG bond index, if you will, in the US, which usually has a duration of around 6. So we will go with B, the long-term corporate bond index. Question 2. Which of the following sectors contributes most towards increasing the tracking risk of the pension fund's bond portfolio relative to its benchmark? Financial institutions, industrials, or utilities? So just off the bat, for tracking risk, we're probably going to be calculating some type of contribution to risk for our portfolio and for the benchmark and for each of these different sectors, and then kind of determining which one is deviating. So which part of the portfolio is deviating most from the benchmark and kind of creating more tracking risk. We left off right here, so we'll start reading at Simpson also manages the bond allocation of a pension fund. According to his research, he has shortlisted sectors that are per the objectives outlined in the fund's IPS. Simpson also selected a suitable benchmark for measuring the portfolio's relative performance. Exhibit 1 displays some information about the portfolio and the benchmark. So here we go. There are 3 sectors: financials, industrials, and utilities. So we're going to be looking at how much each of these different sectors kind of contribute to our active portfolio risk, and so which ones deviate the most and kind of create the most tracking risk. So in this situation, we're given percent of portfolio for the benchmark, and then the spread duration of our portfolio in that sector, and then the spread duration of the benchmark. So what we need to do here is we're going to multiply these two together for financials, and then we're going to multiply these two together for the financials benchmark, and then take the difference between the two. And the difference between those two is going to be a measure of our tracking risk. So basically, whichever one has the highest difference is going to create the highest tracking risk. So I've got that calculation. Let me just pull that in here. Should be able to see that. So financials, we're going to take 34.67% times 6.54. See that right here. And then subtract 36.99% minus times 5.98, so the benchmark numbers, gives us 0.0242. Do the same thing for industrials, and we can see there's minimal tracking risk there. And then for utilities, we get 0.3141. So we can see that's clearly the largest number. So that means it is contributing to the largest amount of tracking risk. And so what kind of throws us off here is we could look at the percent of portfolio in industrials and the percent of the portfolio in industrials in the benchmark. And that's the biggest deviation. I mean, that's a almost 7% difference. The utilities is about 5.5. But the key here is when you start ramping up that duration and the differences between those duration numbers, that's where you really start to, when you're multiplying by those duration numbers, it makes those percentage deviations a lot more magnified and meaningful. So that's what leads us to C, utilities. Question 3. Simpson is most accurate concerning statement 1 only, statement 2 only, or neither. We left off right here. About a month ago, Simpson read an article on the set of risk factors that drive bond returns and determine a portfolio's risk profile. While discussing the article with Kenneth Donziger, his colleague, Simpson made the following comments. Got our 2 statements right here. Statement 1. For a bond portfolio composed of non-treasury securities, the portfolio duration will always equal the spread duration. This is going to be a correct statement. There might be a mismatch between the spread duration and the portfolio duration if the portfolio has treasuries and non-treasuries, but all non-treasury securities are going to have some type of spread relative to the treasuries, and so whatever the portfolio duration is going to end up being the spread duration if every single security has spread. So statement 1 is accurate, so we can go ahead and rule out neither, and now we need to look at 2 just to kind of make sure we can conclude it's A at this point, I guess, but let's just make sure 2 is not correct. If a bond indexer is trying to replicate an index, matching the present value distribution of cash flows of the portfolio to that of the benchmark will ensure that the portfolio has the same risk exposures as the index. This is going to be incorrect. Matching the cash flows ensures that we should have the same interest rate sensitivity and risk there from a duration standpoint. But that doesn't necessarily mean we're going to have the same risk exposures. We may be owning different issuers at different maturities. And so if we're owning different issuers or different sectors, we're going to be exposed to different risks, whether that's credit risk or something like convexity if we're owning mortgage-backed securities at a different proportion relative to the benchmark. So statement 2 is not accurate, and we can go with statement 1A. Question 4. Concerning immunizing the life insurance company's liability, are Simpson and Danziger most accurate? Only Simpson is correct. Only Danziger, both Simpson and Danziger are correct. During their discussion, Danziger mentioned a bond portfolio that he manages for a life insurance company. The company offers a product in which the policyholder received a specific payment at a specified future date for a current lump sum payment. The company has asked Danziger to immunize this liability payment to be made by the company 10 years from now. When Danziger asked for advice, Simpson stated that matching the initial present value of all cash flows of the bond portfolio to the present value of the liability and setting the portfolio's duration equal to 10 years will assure immunization. So this is Simpson's statement. Let's dig into this right now. So we're matching the cash flows of the liability and then setting the duration to 10, which is when the payment will be made. While these steps are going to help immunize the portfolio against a parallel shift in the yield curve, which is what duration kind of tells us, this isn't going to assure immunization against all types of interest rate changes. So if the yield curve changes shape, so if the long end goes up and the front end goes down, or vice versa, a non-parallel shift is not going to immunize the portfolio by taking this approach. So we can go ahead and rule out that Simpson is correct. And since he's in C, we can also rule out that C. So we should be going with B, only Danziger is correct. So let's make sure Danziger's statement is accurate. Danziger added that since the yield curve is upward sloping, the immunization target rate of return will be less than the bond portfolio yield to maturity. This is correct. The current yield to maturity of the portfolio, if we're owning bonds across the yield curve, is going to be lower than what the rates are in the future. Since our yield curve is upward sloping, that means that future rates are higher than our current rate of return. So we can conclude that yes, B, Danziger only is correct.